Hey everybody, my name is Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive technology for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a company called BlackSky and why they're a risky play on geospatial intelligence. So, if you're familiar with BlackSky at all, we covered them before in a piece and looked at their value proposition. So they use satellites to take images of the Earth, so geospatial intelligence, and their value proposition is that they're low latency, which means that the time between when they capture an image and the time between when it's available is very short. So BlackSky decided to go public, as have a number of geospatial intelligence companies, using a special purpose acquisition company, or SPAC. Now, we've covered about 90 SPACs now, and of those, 87% are trading below the price institutional investors paid of $10 a share. So BlackSky is no exception. What started out as a $1.4 billion company is now a $300 million company with shares trading around $2.50. They're far too small for us to consider. So we have a market cap cutoff of around $1 billion. But for those who like risk and don't have a problem investing in smaller companies, we're going to look at some of the reasons why you still may not want to invest in BlackSky, aside from the fact that they're quite small. So we left BlackSky in our last piece looking at the revenue target they had set for 2021, which was $40 million. And we had said that if they're going to justify that high valuation of $1.4 billion, they need to make sure to hit that target or exceed it. So what actually happened? Well, they ended up revising that revenue forecast to around $30 to $34 million, which they said was regarding timing of contract start dates, supply chain impacts, the usual coronavirus excuse that most companies offer up, which probably has some legitimacy to it. Now, just before this presentation, we looked on the SEC's website and we could see that BlackSky filed a press release. That's what SPACs do. No SPAC seems to be in a position to file proper regulatory documents. So they do press releases until they get their acts together and can file a proper 10K. So we got a press release that said they hit their target, which is great. The upper end of that range, $34.1 million. So while they didn't managed to hit the $40 million they promised, they did hit their second guidance, which is great, and they had a good fourth quarter. Now, when we look at the revenue breakdown, on the left here, you can see how BlackSky compares to a couple other geospatial intelligence companies, Planet, Inspire Global. And on the right-hand side are some interesting numbers. Now, we don't have the 10K so that we can show you the full year, but these are representative enough. All right. So the first point to make here is that the US government commands 83% of their revenue. So that's a big problem. And anyone who's been paying attention to Palantir will know why. So we don't invest in companies that derive a majority of their revenues from a single customer, especially when it's the US government, because they have all the leverage at the negotiation table. If they decide to pull contracts, you're screwed. So if we look at that trend from last year to 2021, or say 2020 to 2021, we see that the percentage of revenues for BlackSky coming from the government moved from 79% to 83%. We also see another metric here that's important to pay attention to. So when you're looking at software as a service companies, which we prefer, you want to see revenues over time as opposed to point in time. And you can see here that about a third of BlackSky's revenues are point in time, and that's up from 23% last year. So both of these measures aren't good and are red flags according to our own investment methodology. Now, the other thing we notice that's indicative of how SPACs generally screw retail investors and aren't the most efficient way to go to market. If you look here at when the dust settles, what they ended up paying in fees, the BlackSky deal drove 16% in fees compared to your typical IPO, which is around 3.5 to 7% of the gross IPO proceeds. For BlackSky, that was 16%. That's a very large number. And what's worse is that when we looked at the SPAC deck initially, we were expecting BlackSky to receive about $445 million in cash. That's great. What ended up happening is that as of September 2021, the amount of cash in their books is about 197 million. So for a company that's burning through an average of about, I believe it's $27 million a quarter, it remains to be seen how long they'll be able to last before they have to raise money again, diluting existing shareholders. Now, one of the companies that invested in BlackSky was Palantir, and people have been pointing to that as a positive, but that may not necessarily be the case. There was a analyst from Credit Suisse recently talking about how Palantir is doing something a little bit shifty. So Palantir will make a equity investment in a company, and you can see here all the equity investments they've been making. The company takes that money and goes and gives it back to Palantir in order to use their software. So that's it's similar to how related parties work. If you're familiar with Ginkgo Bioworks and the criticisms we have around their business model and where their revenues are coming from. So they'll set up a startup and then fund the startup, and the startup gives them back the money in the account that is revenue. So the other thing you'll note about Palantir is that ARK Invest has always been a strong advocate of the company. Recently was dumping large amounts of shares following Palantir's lackluster earnings. And ARK was citing a significant deceleration in growth in the larger government division. Well, that's exactly why we don't invest in companies that derive a large percentage of their revenues from the government. That's what we said about Palantir last year or several years ago, why we didn't invest in the company. So when we look at BlackSky today, we see that their valuation is certainly not considered rich using our simple valuation ratio, which takes their current market cap, divides it by the annualized revenues, and we've used the latest, their fourth quarter revenues of 11.5 million, and their valuation ratio comes in at 6.5. That's certainly wouldn't be considered rich. So the conclusion really is that BlackSky isn't a company that we would invest in, not only because they're so small, but when you look at their customer contracts, one thing that we like about SaaS companies is that they have multi-year contracts, which can't just be canceled when people feel like it. Well, the majority of customer contracts for BlackSky may be terminated at any time for convenience. The government decides that they don't want to pay money anymore to BlackSky, that's done. They have 197 million in cash. They're averaging 29 million a quarter in 2021. So they have some runway. The business model is not optimal. This point in time bit, 33% of the revenues. And of course, the worst bit is the government dependency, 500-pound gorilla. And with government as a customer, the other problem we see is that companies will not be able to offer up much information at all about those dealings. So you really don't have any transparency there, any insights into what's happening. You simply get surprised. Those surprises increase volatility. So if you sign up to our YouTube channel, we'll be putting out new videos on topics such as space, SPACs, synthetic biology, all kinds of stuff. Make sure you subscribe. If you have any questions, just put them in the comments section. We'll answer them right away. Thanks so much for your time. Much appreciated.